Hey everyone, I hope you're all doing well out there. Happy New Year's to everybody. This is your end of year market review. So for those of you that haven't watched these videos before, the reason that I put these videos together each month is to give my clients the straightforward information about what's going on in the stock market, the economy, and then ultimately how that affects their money that's invested with me. So for this past year, I have a chart up here showing the rate of return here for the stock market. The price level was up 23% for the year. This is a follow-up from last year where the stock market, which when I refer to the stock market, I'm talking about the S&P 500, was up 24% last year. So these numbers pretty well outpace the Dow Jones, which the Dow Jones was only up, about 12-13% or so for the year. I'll pull the figure up just so you can see it. I don't have it right in front of me, but it was about 10% less than the S&P 500. I never talk about the Dow Jones because that is only a representation of 30 stocks within the Dow Jones versus the S&P 500. That it's just a broader benchmark of how the stock market is really doing. The NASDAQ, which is a lot more technology companies, was up even more than the S&P for the year. That was up 28%. I'll pull the exact number. I'm pretty sure it was 28%, but I'll put that up here in a graphic as well. And you'll see in this chart that I'll put together that where the S&P and the NASDAQ and the Dow Jones were. So this bar graph, though, that I have in front of you right now, I pulled up because I thought it was a good representation to show really what the stock market does on a year-by-year basis. If we go back over time, you can see majorly we're in the green. There's those tan lines there that are in the negative. We had 2022, which was a pretty bad year, down close to 20%. Then you have to go back to 2018, where there was a negative before that, and then 2015, where the market actually was down about 1%. But there's a lot more up years than down years. So I thought this was a really good visual representation of how the stock market goes over time. 70% of the time, on a year-over-year basis, stocks are higher versus, obviously that means 3 out of 10 times stocks are lower. So, we're definitely in a really good stretch. But we've had, a couple years, if we just look back through 2018, we've already had a couple years that have been down. So I've had a number of questions where people ask me, they're like, well, do you think we're going to have another year like we just had? And realistically, while there definitely have been time frames, you can look back in the end of the 90s when there was 4 or 5 years where stocks were up 20+%. But that was when we were in a tech bubble. Right now we're not in any type of real bubble. Stocks actually over the last month have gotten a little bit cheaper. They're short term, a little bit oversold, where if you rewind actually to the market review that I did a month ago, I was talking about how stocks were actually a little bit short-term overbought. So that corrected itself in December, with stocks being down a couple percent for the month. More and more companies just reporting earnings. There was just a little bit more of a fall off in specific sectors like healthcare and financials, just to name a couple that had done really, really well in November that then trailed off pretty heavily into December. So a couple of those areas, both healthcare and financials, I've added to more in the portfolios because of that reason, that they've gotten actually a little bit more oversold than I feel they should be based on my research. But I'll talk about that towards the end here. So these are just some good charts. I thought that was interesting just to see kind of really where stocks are at and likely, to give you a good idea of where they've been at and what we're likely to see in the future. So one of the reasons that I'm so optimistic about stocks, if we look forward over the next 10 years, is statistics like that. So, and really just where we're at in the economy, which brings me to the next chart that I have, which is CPI. That's the Consumer Price Index. The 12-month change is what we're looking at here. These 2 lines that we're looking at, there's the gray one in there, which is overall. This is basically, CPI is an inflation number. So when we're looking at, when they talk about inflation, they're really talking about the Consumer Price Index mainly. So core inflation is at 3.3% right now. Overall inflation is at 2.7%. That's over the last 12 months. So you can see that extreme drop off that we had from 2022 when inflation was really, really high, and the drop off we had there because of the Federal Reserve increasing interest rates. So that's helped out a lot in the economy, which has also then been a result of why stocks are doing as well as they've done, because we had that big drop off in 2022 in the stock market, paralleling the increase in inflation and then the increase in interest rates. But now, because of inflation being lower, they've taken off the last couple of years. Just like, if we look at inflation, it got pretty well under control starting in 2023, and stocks did really well in 2023. They did really well last year, and if inflation stays where it's at, if interest rates don't all of a sudden suffocate the employment market, meaning that companies have to lay people off because they're just slower, then stocks, I feel, should do really well again because of where inflation is at and where employment's at. So, we're still at a very low unemployment rate overall. This chart here just kind of correlates with that last one, talking about inflation. This is the Fed funds rate looking at 2024 and 30-year mortgage rates, which the Fed's funds rate has dropped off, but interest rates for 30-year mortgages actually climbed up after the Federal Reserve started decreasing interest rates. So it's again, another sign. I have a number of clients out there that are kind of in that waiting period to buy houses or properties or whatever it looks like, or talked with other people, millennials, that are looking to buy a house and they're waiting, just renting, because they think that interest rates are going to drop off. And the mortgage rate market is while typically it's correlated to the Fed funds rate, it's not always moving in that exact same direction. This is a good sign. One of the reasons that I feel this is happening is because the people that are investing in these 30-year mortgage bonds, or the investors that back those 30-year mortgages, they realize that there's a huge demand out there for people that want to buy houses, and there's a lot of people in that millennial demographic especially that either are underhoused, meaning that they're in a smaller house and they've outgrown it because they've had kids or gotten married or whatever the situation is and they need a bigger house, or the millennials that are living in apartments or renting from other people and want to buy a house. That's going to keep rates up. It's going to keep prices on real estate higher and drive that even higher when at some point there's going to be a tipping point when people decide that they're done renting or that they're done living in that smaller house that they now want to upgrade. So I don't see interest rates, especially for mortgages, dramatically dropping off, just because there's going to be demand for people wanting to buy houses. So while the Fed's funds rate's likely to go down a little bit more, they haven't talked about dramatically decreasing it because they don't see inflation at the spot that they would like it to be at. The Fed would like inflation more in that 2.5% range for the core inflation number. So until they get that, they're likely to keep the Fed funds rate a little bit higher and not drop it off too dramatically. So there's just some economic updates that kind of take into account what's going on in the overall stock market and the overall economy. But getting into portfolio specific changes that I made within the portfolio, I named a couple already that affect anybody that's got an IRA. You have money invested in the healthcare sector and money invested in the financial sector, both of which I increased those sectors. I cut out the materials sector, which really just it was only a 2% weighting in order to add more to financials and healthcare. I also cut back a little bit in basically just rebalancing some of the gains from the technology sector and adding it to healthcare specifically. For client accounts that are in the more conservative portfolio or accounts that I have Bitcoin in, one of the things that I did is that I rebalanced at the end of the year just to lock in even more gains. So this chart that I have up right now is a chart of the Bitcoin prices over the last 3 years, which is the time frame that I started actually investing client money in Bitcoin. So the first buy that I had in Bitcoin was when Bitcoin had dropped below 40,000, and that was in 2022, and I bought that at that point because it had dropped off. It doesn't show it in this chart, but Bitcoin had been above 60,000, close to 70,000 at the time, at its peak back in 2021, and that was a little over a 50% drop when it dropped below 40,000. So I wanted to start buying some as an alternative investment within more moderate or conservative portfolios, really to just get a little bit more diversification away from the stock market, because I don't want everything moving directly aligned with the stock market. Buffers, which I have in those portfolios, had done really, really well last year. I actually added a different buffer to portfolios, which I'll probably talk about more actually in next month's market review, but the buffers have done really well in replacement of bonds, but the buffered strategies still move in correlation with the stock market. Bitcoin doesn't move in that direct one-to-one correlation with the S&P 500, so that's one of the reasons that I added it. It's at most 5% in portfolios. What I did is that I cut it back in those portfolios. It was 5%. It's now more like 3.5%, 4%, so just taking some of that gain that we've had there. Our original, for people that have been with me for 3+ years, our cost basis in that was in the mid-20s, because when I started buying it at 38,000, 39,000, it continued to drop in the end of the 2022, and I was able to buy it a few different times, one of which was when it was closer to 17,000, which really lowered the cost basis on the position, meaning like our average price, that's the cost basis. Not that within an IRA the cost basis truly matters, because you're not paying taxes based on that cost basis, but I was able to lower it to that level in the mid-20s, and then as things took off in 2023, I ended up selling a portion of it towards the end of 2023, and switching that was actually the beginning of 2024, when there was a new spot Bitcoin fund that had started, and that tracks the spot price, meaning the exact price of Bitcoin at every given time, versus there's a futures-based price, which is based on the future price of Bitcoin, not to get into the minutia of it too much, but that wasn't available until the beginning of 2024, when the SEC approved the spot Bitcoin funds to be traded within the US. So I switched that over there, but I had rebalanced, taking about half that position off, just because it had made over 120% in 2023. And then, of course, this year it was up even further, where it was up, a little over, it was actually up another 150%, 160% from where it was in the beginning of the year. So there was another trade that I made on it in the late spring, and then this past trade, because we had that huge run up after the elections. So it was just, again, taking more off the table. For people that have been with me for 3 years, at this point, we've actually doubled the position, our gains within the position, and then taken that profit off the table. So you've made double your money, and then we still have, in most cases, twice as much as we did back in 2022, still invested in it. So at this point, we're more than playing with the house's money, which is an ideal spot to be at. While I think that right now Bitcoin is a little bit overbought, I think we'll probably see some type of pullback at some point to it. Wouldn't be surprised if it went back into the 70,000 level at some point again. But if we're looking at this from a long-term investment standpoint, I want to keep it in the portfolio, because I think it's important to have as diversification, and I think it's something that long-term is going to have a lot of upside to it as cryptocurrency becomes more mainstream. So if you have any questions about that or any of the other changes that I made within the portfolio, don't hesitate to reach out to me here. For those of you that I typically do the Zoom meetings with to do investment reviews, I just sent out to about 60 households here yesterday. I just sent out emails to, that was Friday because I'm shooting this on a Saturday, but I just sent that out on January the 3rd to everyone to schedule reviews for this month. If you'd like to do a review, just click on my calendar link there, and that you can set up a time to do an investment review, and we can talk more specifically about your portfolio. But for anybody else that we're not scheduled to do a review this month, but you'd like to do a review, just reach out to me, shoot me an email, and I can get you that calendar link to pick a time to do an investment review, and we can do a Zoom meeting that way to talk more in depth about things. So, but if we don't connect here this month, and we don't talk at all for whatever reason, I will see you guys all here next month for the monthly market review next month. Appreciate you all taking the time to check me out.